Joan, you'll be so proud of me, and Danielle and whoever is an Excel guru, figuring out how do we just plug in the numbers and we can see the what it would be like if we have pro rata and if we don't have pro rata. So I owe you that one. The other tool I would like you to get is the set of questions that I ask when I'm looking at different startups and evaluating them. And then the third thing that I would like you guys to get is one pager where you can actually plug in the information that you have learned from this Q&A as a snapshot of something that you can figure out if you want to invest or not. So I will get those three things to you for sure, but I need some time to just bundle it all together. So those are the three tools that are coming at you right after this. So let me share my screen. And we'll quickly go through what we did last time. Hold on one second, okay? Any questions that I can answer in the meantime?
Sorry, Jags, was that? I apologize for being late.
No, we were late too, so no worries.
And were you talking about 99 Angels or?
No.
Or what are you emailing us? I missed.
Oh, so these are the three tools that I use that are, so one is the waterfall analysis, which kind of gives you an idea about if you invest this much and this is the valuation, this is the percentage of the company you own, and how does it get diluted, every series. And it's an Excel spreadsheet where you actually can just plug in the numbers or, change it the way you want it. But this is my version of it. The second thing is the questions that I usually like to ask startups when I am interviewing or assessing them. This is the post. Remember the three stages that we talked about: the pre, during, and post. So this is the during part, my first meeting, and then the third thing is the information that I capture out of that into one pager as a snapshot of where does this particular startup fall into my thesis, and if I want to invest, do I have all the information I need as a snapshot? So those are the three things that I think can really help you, not only do your due diligence, but also to maintain your portfolio. And then you can obviously change anything you want in that. So let me know if you guys can, if you see my screen. And I apologize if it's not the full screen. You see the slides on the side of my daughter's computer, so I don't want to mess too much. And so I'm just
looks good.
Going from my Canva account instead of downloading it on her desktop, etc. Okay, sounds good. So let's just quickly run through this. We talked about the 4 valuation method last time, which was weighted method, dilution method, VC method, and market driven. The weighted method is based on the most important criteria. So what is the most important criteria are the 7 things that we talked about: problem, solution, what differentiates them, market size, their revenue model, their team, and what they're, what are they asking, right? And then remember I said that I use this method not to look at a company 5 years out or 2 raises out. I look at this as the most, as what I'm investing right now, and what am I, what is the most important criteria for me to evaluate this company for until their next raise. So if they're going from seed to Series A, and I feel that the revenue model is the most important until the next raise, then I put the most weight on that, and the score is from 1, 0.75, 0.5, 0.25, and 0. And whatever the number I come up with, and I average that factor, and I have an example underneath, so we can go through that. And I multiply that factor with the average valuation in the industry for a similar company, and that's how I come up with the valuation. Sometimes I use a couple of these methods if the valuation is way too out, and I want to just see like what would it be. So I use a couple of methods to just validate my thinking. And this is the example. So let's say that the team, market size, differentiation, traction, revenue, problem. So problem solution here is this, is one, and I put the weight, right? So if the team is the most important thing for them to get from now until the next race, I put the most weight there, and then I give them a score of 1. And that's how I come up with the 7 factors. And then I total average them to 0.65. And the average valuation for a company of this size in this industry is, let's say, around 5 million. And then I come up with the valuation for this particular company at 325. And this can vary. We both, all of us could be looking at the same company, but it could vary depending on what thesis you want, your thesis, what do you think is the most important criteria? So that's how I came up with this is how I use the weighted method. Any questions here? Okay. Valuation.
Really quickly,
Sure.
for slide 4, is this going to be part of the Excel spreadsheet you're talking about?
No.
No.
This is I feel it's pretty simple. We can just I can put it together. It's just multiplying, but the waterfall analysis I'm talking about is the actual. Let's say that you invested in this company and you have a pro rata, right? And if looking in future to see what kind of multiples you could get for that company, that's the waterfall analysis.
Okay, thanks.
Dilution method is based on what percentage is given away in this round. So we kind of talked about that burn rate over 18 to 24 months, which is until the next raise. And they are planning to raise 20% in the next round. We don't know what the valuation is. Usually the industry standard is about between 15 and 25%. So I took 20%. So an example here, I went with whatever we used last time. The burn rate is 55,000 a month. So over 18 months, 55 times 18 is around 1 million. Assuming 1 million is 20% of the next round, the post money will be, assuming 1% is 20%, post money is 5 million and the pre money is 4 million. That's the valuation. So if you get a convertible note and it says $8 million cap, and if you use this method and you said, you know what, I feel comfortable, I feel that the valuation cap should be 5 million, you can negotiate that and you can actually show this thinking, if you want, to them, saying this is what I feel is the most reasonable based on your burn rate. Obviously, we are not looking at the revenue and all that stuff. So that's something in addition to that. The VC method, which is the most widely used, is based on the acquisition price and desired return multiple. So they look at like, what do I want this company to get acquired for, and what kind of return do I want from this? If I invest now, what kind of return multiple I'm looking at. Sorry, this should not be here. I apologize. Burn rate over that belongs to the last slide. So that is something that we also went through this. And where is that example? Apologies again. Sorry. Let me hold on one second, okay? So I can answer questions while I am looking at my that example that I thought I had put in there. I know we had a lot of questions around the VC method, so I just want to make sure that we have the information, the example, because I know that Jennifer was trying to put it into the Yeah, right here. Okay, it does, it's there, except it comes right after this. So let's see. Yeah. Okay. All right, so you guys see this? So this is the VC method example. So let's say the current raise, they are raising $1 million, right? Revenue in year 5, founder thinks it's going to be $40 million. Revenue in year 5, from an investor perspective, they divide that by half. So it's $20 million. And we talked about this last time. That is that the industry, is that how VCs look at it? I don't know exactly what the division number is, but usually it is. I've seen it, and I do it in half, because founders are by nature optimistic, and investors by nature are pessimistic. So if the founder thinks that they can achieve 40 million, great if you achieve that. But for my calculation, I'm going to take half of that. And the revenue multiples for this industry is, let's say, 2, right? So then I multiply 20 million times 2, right, in year 5. That gives me the acquisition value of $40 million. And if my desired investor return is 10, then the acquisition value, so the required post money is actually, 10th of what will be the acquisition value will be. So that's 4 million minus 1 million that you're raising, which is 3 million. So the percentage of the company giving away is 0.25. So right now, if the founder raises 1 million, it would be about, I'm going to say 25% of the company is being given away from a VC perspective. And I'm going to say that I am comfortable at a valuation of 4 million post money and 3 million pre-money. Obviously, founder is going to shake his head and say, no, I am actually really believe that the 40 million is something, of a conservative number. So if I look at the 40 million number, this is the valuation. Post money goes to 8 million, and the pre-money goes to 7 million. So let's say that we consider that founder knows what they're talking about, and it's $40 million, and the revenue multiple is 2. So the acquisition value will be about 80 million. My desired investor return is 10. So I divide 80 million, divide by 10, and that is the post money right now, which is 8 million, and required pre-money, which is 7 million. So in this case, the percentage of the company given away at an 8 million valuation is much smaller. So it's 1/8. So it's what, 16% or something like that, or 12%. I don't know. Let me see. So I hope you were able to follow that. Yeah, 12.5%. Any questions here?
Jags, I have a question. So
Sure.
Can you talk more about the revenue multiples? Like, how do you said like that would be for that industry? Like, how would you get that number?
Yeah, can you hold on to that? Because that is the topic of today's session. So what revenue multiple, what that means is that if I have a product company, the CPG company, my acquisition, so acquisition usually is the multiples of revenue, because that is the only number that matters, that how much money are you bringing in, and what is the value of your company based on that number as you move into Series A, Series B, etc. Right? So in some industry, the revenue multiple is 2 times. 2 to 3 times if it's a one-time product that you're purchasing. For example, lawnmower, right? If I come up with a different, really amazing lawnmower model, right? I am going to say that I purchase lawnmower probably every 10 years or 20 years, right? So the revenue multiples, I'm not going to get a repeat business from the customer. So the revenue multiple is going to be much lower. However, if it's a SaaS company, right, with a subscription company, especially in software, because the operating expenses are much lower. Once you develop that software, you have to maintain it and add features to it, but the base is majority of the work is, you know, almost complete for that particular product. So your margin increases over time. So your revenue multiples, you know, are very attractive. So you can get acquired 10x, 7x your revenue. So that's what I mean by revenue multiple. Does that make sense, Lucinda? I think it was
Yeah.
Lucinda.
Yeah, yeah, thank you.
All right, and then we'll go deeper into it, and I have a link for you, which is a research by NYU that actually talks about what are the historic revenue for industry, and it's so I have a link there, so you can actually look at that as a what do you call it, as just a guideline, right? Like for example, RX Bar, right? The RX Bar got acquired for like 7 or 8 times their revenue, right? That is something very, very unique in the CPG, food and beverage industry. And reason for that was they saw that the future value or the product that they were developing. So RX Bar went from like a really, you know, your regular protein bar to a clean label protein bar where it says 2 egg whites, X, Y, Z, everything that I can understand. So the future value of that particular product was much higher than what they have, you know, so that's why they got acquired at, I think, $600 million or something. So that's what I mean by revenue multiples. I hope that was example was useful. All right, so then we'll go one slide back, and then we talked about the market-oriented method is based on what's happening in the market, right? So this is when the market-oriented method is when the founders have an upper hand, in a sense that it's a party round where they say that this is what I'm raising, this is the valuation, take it or leave it, right? But even then, do your research. And I'm not saying that if just because they say that, if that's the case, you can definitely, you know, it depends on your relationship with the founder and where you are. If you're a previous investor in their previous company and you have built that relationship, there are times that I don't agree with this, but I have seen it that the founders have multiple term sheets in the same round. One for the, you know, they say, I really value what you bring to the table besides money. So it's not advisable to do that. And I always ask that question after being burned a couple of times, that do you have any other term sheets currently circulating in the market? And, you know, so I want to know what they're doing. So most of the tech companies, and I'm going to talk about tech acquisitions because that is something that I look at quite a lot, and majority of my portfolio is tech. Majority of the tech acquisitions are under 30 million. We think that, so you really want to ask your question, ask this question, if majority of the tech acquisitions are under 30 million, and I'm investing at 15 million, what kind of multiples am I going to get, right? Especially in the early stage. So you really want to ask yourself this question, is the valuation that I'm investing in, knowing the majority of the tech acquisitions happen under 30 million, is this the company that I see going to 100 million? That is actually a really good question to ask yourself, that if you don't have that conviction in the company and you think that the company is really good company, but they're in a crowded space, they don't have a niche market, or even if they have a niche market, the problem is something that's not as painful for customers, so they can live without it, fine. If they have it, great. You know, so you really want to also, if possible, do some online research, or if you get an opportunity, talk to their customers to say that, you know, how much time do you spend using this product, right? Many times we don't have access to that because either we are investing at an early stage or we are investing such a small amount that we don't really, you know, have access to the people, the customers that the investor, the founder is going to connect us. Here is an example that I'll give you. So I invested in this company called Mojo Vision. They are based out of Saratoga, the town I live in. And I didn't know that. that they are based out of Saratoga. So Mojo Vision is like the Google Glass, but a contact lens, and they have a lot of patents and amazing technology. This is one of the only company that I invested in, which was evaluated at $400 million. And here I am with my, $50,000 check. I'm nothing. I'm like nothing, meaning, I have like 0.001% of the company at that point, right? But that 50,000 was important to me, and I believed in this technology. I believe that this is a billions and billions of dollar worth of the company that, it's a really, really good technology. That's the future, and I saw the future value. What I decided to do was I decided to go in, and I walked in the door. This was pre-COVID. And I said, hey, I am here and I'm interested. I'm not interested. I'm investing in your company, and I want to talk to somebody who can help me understand your product better. And they looked at me, and here is like the receptionist, total startup, right? It's like, okay, do you want to talk to CEO? I'm like, yeah, that would be great. So obviously she called Drew. And Drew said, oh, no, I am busy. In his mind, he is like, I'm a $400 million valuated company. I don't have time to talk to this angel investor. But he said he doesn't have time because he probably didn't. But he said, ask her to leave her email, and I will see who can help her get her questions answered. If they don't want to brush me aside either, because I can, it's just not a nice thing to do, right? So Drew, I gave my email, and 2 days later, I get an email from a VP of engineering saying, hey, Drew passed me your information. Happy to get on a call with you if needed. And, happy to tell you what it's in the public realm. We are not going to, he was very clear that I'm not going to tell you any of my secrets. I got on the phone with him. And he's like, okay, and I was clear. I'm like, I'm only investing $50,000 at a $400 million acquisition. So, but I really want to understand that where are you with developing this technology, and do you have any current customers? Now, I knew that information from the pitch deck, but I didn't tell him that. So, because a lot of the times what's on the pitch deck is very, happy and flowery, right? So he's like, yeah, we cannot talk about, but we are feeling really good about this. And we do have some Fortune 500 companies. I'm like, okay, don't give me the name of the company. Just give me a use case. Why are your customers think that they cannot live without something like this? And he gave me a use case, which was, for mining workers. And I'm like, okay, that makes sense. Or for the oil drilling stations out in the Gulf, right? I was happy with that, and I made that investment. It's still alive, kicking. Let's see where it goes. But I didn't have any say in any of the valuation or anything. But I did see this company going to be a $1 billion company very soon because of what they were developing. So that's my example. Sorry, I'm still taking time out of today's session. So I just wanted to. This is the example. Wanted to just review that. And this is the waterfall analysis that I'm doing that you can actually see pre-money versus post-money. And you can say the seed round, if I invest in this, then what does it mean for the future round? And I think we went over this, I think in session 3, but this is what I'm creating the spreadsheet out of. And the next valuation, right? So this is what I was talking about. Actually, it is in today's session, it's in last week's session, not in today's session. So Lucinda, here is the exit valuation. So revenue multiples is used for growth stage companies that are not yet profitable or barely profitable. So revenue multiples are usually 1 to 10x times 5-year revenue equals the enterprise valuation. So we talked about the products, right? So if it's a lawnmower, it's usually 1 if it's once every 10-year purchase, 3 if it's more frequent than 10-year. So that's why it says one-time revenue with low high frequency, right? So if the frequency of you purchasing the product again and again and again is high, then you are more towards 3 to even 5x. For SaaS company is about 4 to 10x. Again, SaaS meaning, if it's a 4x, if it's like, enterprise level SaaS versus a customer, CRM type of SaaS. So even in SaaS, there are different types of companies that it can go from 4 to 10x. Definitely the higher the recurring revenue in the shortest amount of time, the higher the revenue multiple. So the multiple range is based on, like I said, revenue type, if it's a one time or 3 times, gross margin. If it's a low multiple, if it's the gross margin is less than 50%, and if it's a high margin, greater than 66% is a higher revenue multiple, and obviously the revenue growth. So if you are in a market that is established market, right, but they're just coming with a new product, then the revenue growth is going to be much slower. But if you are in a market, which is my favorite sector, if you're in a market which is the old market, but it completely lack of technology, and now technology has made it so productive, efficient. I love those kind of industries where I can see the business model is proven. People need this, but they are putting technology spin to it, and the revenue is going to be great. So the example for that is my latest investment in Nautilus. I think I talked about that, is the ships, right? The containers on these big ocean ships. And we all know what happened with Panama Canal, or, I think it was, it got stuck and all that stuff. So this company just raised $6 million, and they are coming up with an airplane, and they're not just taking an existing 747 or 78, whatever it is, 737, and saying, okay, now it's a cargo plane. That's what Amazon is doing. That's what FedEx is doing. That's what UPS is doing. What they're doing is they're taking this, the technology of flying in the air, technology of the logistics of moving big containers, combining the two and saying that we are creating a vehicle, or which can be autonomous, that can fly with the big shipping containers, the same volume as ocean freight would. Idea is, I think it's doable. Are they there in the next 5 years? Probably not. They have a lot to do, but that's something that I can see happening. So I love industries like that. And this is the link I talked about. And if you click on this link, it'll tell you, let me see if I can share this. Stop share. Can you guys see this? It says, not found. What? Okay, well, I need to send you that again. Sorry about that. I looked at it earlier today and it was there. Okay, here. Yeah. Sorry, I'm gonna bring this one. Do you guys see this? Yeah, I can't see you guys. So somebody-
Yes.
Okay, so this
Yeah, we
is
can see it.
yeah. So this is the link. I don't know why it's not working in the other, but if you can see the industry, like advertising, number of firms, price per sales, net margin, EV sales, pre-tax operating margin, and that will tell you like what I think if I also has all this data is actually really gold, right? When you're looking at this, you can look at it that the net margin, right? Like what is the net margin? Like this is banks, 23.79. So fintech maybe, you know, coal and related energy, minus 31.79. But I also know that I think these are some of the price per sales also, you know, can be calculated in your revenue multiples, just to do some research. I thought this is really useful for me to look at, you know, if I get come across any startup that I don't know much about, or I want to know more about, this is one of the links. Let me, and I'll send that. Okay. All right, so that's where we are for, that was last week's session, sorry. So now we can, if you don't have any, you know, if you have any question while I pull up the next week's sessions, please feel free to, I mean, this week's session, please feel free to let me know. And so today we are going to talk about frameworks. Yeah, any questions?
I don't have any questions. I just know I'm gonna have to go. I missed the last session, so I'll definitely work on that this weekend.
Thanks. And, you know, I'm happy to connect with you guys all one-on-one if you have some questions specific to what you want to do, what you're doing, how you want to move this forward. You know, Kate and I are here for you. But, you know, if you want to ping me and say, let's meet one-on-one, happy to do that. So no worries. If you miss it, you'll have all the recordings.
Okay. And did you guys post the one from Tuesday? Because I didn't see it.
No, because my computer crashed, Laura. So I lost the what do you call it, the slides. So we kind of just had a conversation on Tuesday, and that's why I went over the slides today.
Okay,
I
got
think,
it.
yeah. So Kate will send
Laura,
you recording. Yeah, go ahead.
yeah,
Kate.
Laura, we will get you the recording on that. But just note that it's, again, mostly conversation, and it could fill in a few holes with what Jags just went over here.
Okay, great.
And you'll obviously get today's recording as well as the session 5 and session 6 slides.
Okay, awesome. Thank
Right.
you.
Most welcome. All right, so today we are talking about framework. So if you are looking at your thesis, and let's say Laura wants to invest in fintech and Beth wants to invest in you know, cloud software, and Jennifer wants to invest in media, how do I evaluate those companies which are in totally different sectors, yeah, but they all are early stage or, you know, seed stage? How do I evaluate those companies? So I go by the 80-20 rules, right? No matter what sector you're evaluating, 80% of the due diligence is the same. The 20% is sector specific. So what I mean by that is those 7 things that we talked about, right? Problem, solution, traction, revenue model, market size, competition, team, where you, and all the financial statements, which is where you are and where you want to be. You must do that no matter what industry it is, right? So the 80% of the due diligence that we talked about remains the same meaning in the same areas that you should do the due diligence that we talked about in session 3 and 4. But the 20% is sector specific. And I'm going to just go over some slides here, but then I'm going to take you to 5 different companies, and we'll go through their pitch deck / the information that we did in the due diligence, just so that you have an idea. And those 5 companies are in totally different sectors from the other. So you'll get an opportunity to, you know, ask questions or see how they were, you know, the investors who were in, you know, who did the due diligence looked at this, the sectors and these companies. So no matter what sector you're evaluating, 80% of the due diligence is the same, and 20% is sector specific. And also one more thing I want to add here is that make sure that you have your thesis as the common thread weaving through everything you do. because when you decide that when you don't have your thesis in mind, especially in the beginning, unless you want to be a generalist, your thesis can be a generalist, right? Like, I want to invest in everything that I feel good, that has a growth potential, whether it's technology, whether it's food, whether it's fintech, whether it's health tech. That's fine. Like 500 startups is based on that, right? And there's a quote unquote, they say we spray and pray. That means we just invest in good companies, good founders, good ideas, and hope that some of them do well. And they've been very, very successful, right? Similar thing with YC. Techstar also has a general, but also they have tech specific, food specific, space specific. They just opened an accelerator in Los Angeles, and they have amazing startups that are in space technology, and they have demo days. So figure out what sector, what is your thesis consist of, and try to get invitation to those demo days. And if you need help with the invitations, let me know. I know a lot of people, or Kate know a lot of people in the industry, so we can also get you an invitation if you're not having luck on your own. So yeah. These are the sectors that I have looked at, and I have done a little bit of investment. Most of my investment is in software and in voice technology and food. So food is not even on this, but I have come across all this, companies and sectors. I think to my and don't quote me on this exact number, but in my 8 years of angel investment, I must have looked at over 10,000 decks, and in various industry, and how many companies that I invested in? About 60. So you can see that the funnel has to be really wide. And then as I grew up as an angel investor and became mature, understood a little bit, failed a lot, had some success, I became better and better in figuring out, what is it that I want, what in my thesis, what kind of companies I'm looking for, and what is the path for me for the next 10 years, right? My 10-year clock starts every year. So every company I look at in 2021 is 10 years out. Companies that I looked at in 2017 is 10 years out. So every company, I know that it has a 10-year path. Right, so that's how I look at that. In 10 years, do I feel that this is the company that's going to, be the one out of the competition, et cetera, et cetera. So market or CAGR, I talked about this a little bit earlier, but in a different way. So what is CAGR? Compound annual growth rate. So you could invest in a company that is in a mature market, but their CAGR annual growth rate is going to be smaller. Or you could invest in a market that is growing, or the growth oriented idea, and your CAGR is in the beginning years, you were going to say, oh, the other company, the mature company is, is much more valued. But as you can see, as the time goes, if you're invested in a growth company, that after year 5, 6, 7, and that's why I say 10 year out, it actually starts to win. So in a Nautilus example that I gave you, if I go with an ocean freight company, let's say that does have a really good, they are coming up with this amazing technology, lighter ships that can hold more weight. It's an established market, and that is something that if I was, if I wanted to put in a container on a regular ship versus this newly designed ship, it's all going to be cost based, because the amount of time it's going to take to go from point A to point B is going to be the same. So that company with a new ocean freight probably fall into the mature market. But if I look at the Nautilus model, which is design of a new plane that can carry the equal amount of the weight as a ship and able to get from point A to point B much faster, that is a growth company. Is this going to happen? The customers are going to get converted in first 5-6 years? Probably not, because in the beginning it's going to be new technology, a lot of hiccups, etc., etc. But if I see, you're 5, 6, 7 out, I really feel that if they are successful, they can overtake the ocean freight market. So I hope that example was useful. Any questions here? Okay. Founder, I put a lot of emphasis on founder. A good founder is nice to have, but a good founder with a unique insight and industry experience is a need to have. So good founders with unique industry insights are best positioned to action on their startup's vision. So here because I have invested in this, I have some experience investing in startups, 60 startups. I started plotting my founders. So the plotting, when I say it's just, x-axis and y-axis. X-axis goes from the, industry expertise or unique insight to having, not industry experience and unique insight. And the y-axis is the coachability, in my opinion, or listening skill, or feeling that they don't, even in coachability, I have 3 criteria. When are they able to take others' advice and process it, and then either take it or leave it, but process it without affecting their ego, right? The second that I look at in a founder is that who are they surrounding themselves with? Do they have a good advisors, right? So that also I put it under coachability, because advisors are going to coach them, right? So do they have people who have more experience with them, whether in their team or as an advisor? And then in the third thing in coachability that I pay attention to in that area is that, are they able to hire and retain and grow and have the culture that aligns with what the growth of the company is requiring? So I have plotted my founders, and I have I'm now at, because I have 60 founders or 60 plus founders, because some of them have multiple founders, I can see the success that, for me, the success came from not the idea, but a founder's ability to execute that idea and really have a growth mindset. When I say growth mindset, I'm talking about more about the founders who understand that they don't have everything they need in order to, do everything. So are they able to have this growth mindset and bring on people and elevate people and grow their team, et cetera, because that's what's going to take them from Series A to, beyond. Pre-Series A, it doesn't matter. And a lot of these insights that I'm talking about only come in play after they have grown to certain points. But now, because I have invested in, X number of founders, I feel that this plotting helps me, even though I don't know much about the founder, to see, like, is this the kind of founder I want to invest in? Because I'm not just investing in the idea, I'm investing in the team behind the idea. Because if they can't execute, it doesn't matter how good the idea is. And we all have the, excuse me. Shoot. We all have the experience or know the story of MySpace versus Facebook, right? So, I mean, that's VRBO versus Airbnb, et cetera, et cetera. So that's what I mean by paying attention to the founder. And when you look at, and the reason I wanted to include that as part of the framework, I'm now talking about the 80% of the due diligence, no matter which industry that you are, looking at. Traction. Sorry, I'm just going to move from one slide to the other. Feel free to interrupt if you have any questions. Or Kate, if there is a question in chat, please let me know. Traction is only good if it's sticky, right? So for early stage startups, the question is not if there is traction, is because how long that traction will continue. So a lot of the early stage companies that I come across, they say, oh, we have, 60 customers the first week we started, or first month. I want to ask them how many of those 60 customers are your friends and family, your colleagues, and how much of them are actually paying you? Because unless they pay you, the pain is not deep enough for them to actually consider you, right? So the traction is important. I want to, I definitely love those early numbers, but I want to also know that is this something that you hope that it continue, you continue to see, or is this going to be like a cycle, like some, we get customers, we lose some, we get customers, we lose some. What are you doing to have this going up steadily? So that's where the month over month growth comes, not the first 2 months or 3 months. Yeah, I want to know that, but I also want to know that how are you going to continue? What are some of the metrics you are looking at? What are some of the things that you believe you have in place in order for you to sustain this growth, right?
Right.
And,
Jags, I'm sorry to
yeah,
interrupt.
no, go ahead.
I was just curious. You have so many great stories. Like, have you ever had a story where something like this happened? Like, you thought they thought they were going to have a lot of growth, and then then it fell off somehow.
Yeah, I mean, COVID is the big trigger, right? A couple of my startups, they were doing really good, and they were in hospitality. And these are my early investment, hospitality industry in India. One of them is, around retreats and, all that,
Wow.
the hospitality. They were completely shut down. They're no longer alive, because as a startup, they needed new money because they lost their customers. So they needed new money to continue. And even as investors, we were not sure what was going on. And a lot of times, some of my investors said that, no, I'm just investing in stock market right now. I don't want to, put money, how they say is what, don't put good money after bad money. That's how they looked at it. It's like, okay, we don't know when the travel is going to open. So I don't want to, I already invested a little bit. I don't want to invest more because I feel that I'm going to lose my money. So yeah, that did happen. Another pleasantly surprised a company that I'm not investor in, but I'm working with in coaching them in their business strategy, is Wavy. Wavy Travel. They started with the travel, but now they have completely pivoted. And now they are giving these experiences for tech companies to bring for their teams, their employees, to maintain the culture that they want to continue to have remotely. As you know, Twitter said, you can work remotely forever. A lot of companies are doing that. A lot of companies are getting out of the leases they had in San Francisco and saying everybody work remotely because they're saving a lot of money. They don't have to feed the employees. They don't have to do their dry cleaning. They don't have, so there are a lot of benefits for companies also to go remote. So Wavy kind of pivoted, and the only reason they were able to pivot is because Canadian government stood by them and said, we will give you the money you need in order to sustain yourself. And they were able to actually take that money and pivot and created this amazing platform. So that's also a good story, right? And they increase their traction in a totally different
way.
Yeah.
I guess, no, those are great answers. Thank you. I think if I could, I have just like a question about this. Like,
sure.
One thing that I saw was this new company that does very sustainable materials to make fancy shoes, right? That are comfortable, but they're made from the right thing. So that makes me feel like people who are early adopters to recyclable materials and fashion would be the first people to buy. But how do you know that will sustain? Like, my girlfriend's not going to spend $400 for a pair of these shoes that are made out of whatever. So as a potential investment, what are some tips to know if you think there's going to be traction or not?
Yeah, and that's a great question. I'll give you an example, which I believe I gave a few times. Girlfriends Collective, right? They came up with this active wear, the material they came up with came completely from recycled plastic bottles. They came to me and they said, you know, and I was like, well, great, everybody's buying this, but for how long, right? And that point, their price point was relatively high. They were, so what I would suggest, one of the things that you may want to have a conversation with them, and I missed out on that opportunity because I thought exactly like, I'm not going to buy, you know, $100 or $75 when I can buy Lululemon for that much price, right? So one thing I wish I did, and you know, maybe you can have a conversation with your the founder that you're thinking about investing in, is that great, this $400 shoes are your beginning. Do you believe that any point, how long will it take you to go from $400 to $40 shoes? Because it all comes to price at the end of the day, if you want a mass adaptation. So if you are saying that this is good for I totally believe in that. Tell me how long will it take you from going from $400 to $40 if your customer persona is everyday average, you know, Joe Smith or Jan Doe. If your customer persona is only a higher end users, tell me what more you're doing to the shoes, so they will say, I can never get this from anywhere else. I have to go with this brand. So those are the two questions that I would ask them: is what is your end game? Who is your user? Average, you know, who is your user? What persona? And if it is an average person, can you get it to $40? And if it's not an average person, if it's a niche market, tell me why would my niche market would go with you, besides the material, which is sustainable and all that stuff. That's great, but give me something more, because that's what's going to drive the sales or the stickiness. I hope that answered your question.
Yeah, and if I could chime in, this is Joan. Related to demographics and who it's about, I think it's really important, as you all are talking about, am I the target demographic? Would my girlfriends buy this? I'm evaluating more and more companies where I am not the target demographic. And so I think it's really interesting to think about, like, literally talking to the target demo and saying, is this a pain point? Would you buy this? Especially with, $400 shoes, for some demographics, that might be absolutely the median price point. So I think just really thinking about who is buying and who is the buyer in different scenarios.
Yeah, and also don't ask the people who are like you, right? Go out on the street and just tell somebody, hey, can I ask you a question? Because if you ask the people you know, the answers you are going to get are the answers you probably want to hear, or they are in the same thinking wavelength. So I always say that for the consumer product, this is the best thing any investor can do, is take the product or the picture of the product. And if you're going, I know it sounds weird and, it's uncomfortable, especially for me, because I'm like, oh, how do I, just talk to a stranger, right? But it's really important to do that. And another thing I wanted to also talk about the user persona is, there is in between too, average Joe versus a niche market. So then ask them, are you doing the customer segmentation, right? Okay, you're starting with this niche market, but how are you going to move in order for your revenue to grow? And how many times this person who buys $400 shoes a year are going to buy your shoes, right? How are you going to become the only brand in their closet when it comes to shoes for $400? Or you can go to the $40 and say, okay, how many times am I going to buy a $40 shoes? Probably multiple times, different styles. Are you also planning to be the only brand in their closet? Chances are you're not going to be for a lower priced products. However, how are you going to differentiate yourself among everything else that person owns shoes wise, saying these are that becomes the choice of the shoes. We all have so many shoes, but when we are going out, we're like, oh, this is comfortable, I'm going this. And I can tell you that there's one pair of shoes that I own that goes everywhere. Are you going to be that pair of shoes? So these are the questions that you want to ask, not to like prod and make them uncomfortable, but for yourself, because you want to understand what you're investing in.
So good. Thank you so much, both of you. Yeah, that was great.
All right, great, awesome. Traction plus execution equals the mode, right? We all, what makes you defensible, right? And if the answer is, oh, my IP, that's not good enough. IP doesn't mean much anymore, because I mean, it does mean a lot, don't get me wrong, but when it comes to revenue, you could have the best IP, best patent, but if it's not the execution and the traction, and continue to be in conversations with your customers, that is so important. So having that touch point constantly that helps you, a touch point with your customer that helps you increase your traction and execute well, is very important, especially for CPG brands, or the shoes or the clothing or the product brand. For software, right, traction is important, execution is important too. However, if you have an enterprise as a customer, the lifetime value is probably 2 to 3 years, right? But it also takes you that long to get qualified as a preferred vendor and the vendor of choice. And then you are good for 2 to 3 years. However, customer success is becoming more and more and more important, no matter what your product is, no matter what your service is, because there's always a choice. Sooner or later, they're going to figure out that either you don't care about the customer service support, or your execution is not what they thought it was going to be. And the pain point hasn't really gone away. Yeah, I mean, it's a Band-Aid approach versus a root cause analysis approach, right? So you really want to be in touch with your customer and have that constant flow of communication, that to learn more, to invite them to participate, and know that only 3 to 4% of your customer base is actually going to get involved and give you feedback, but that's 3 to 4% is much more than zero. So constantly be in this space, and that's what's going to create a moat around you. So the Birchbox model, right? Where it was one of the first ones, and a really great idea, subscription model. And she didn't even spend money on buying this. These were the samples that she got from, various beauty companies. What a great model. What was her moat? She executed really well. And it wasn't just box that I was getting a little card with the box that says, how do you use this? What is the month of March is all about flowers and springs and colors. So your moat doesn't always have to be a technical moat, but it could be, I believe branding and marketing is exceeding the moat created by technology in today's world. And the last one is, do you believe that for all the quantitative and qualitative data that you have gone through, you can collect, at the end of the day, you believe in this company? Do you have conviction behind this? So for the shoes company, right? Do you believe that this is going to be successful? And do you have conviction behind not only the idea, but the business model, and most importantly, the founder, right? The founders, the axis, y-axis, and x-axis we talked about. Create your own. Figure out what kind of founders that you have experience with, that you would like to work with, and you feel that they are successful. And I think one of my mentors, I told you this, one of my mentors told me that when you invest in a company, don't find the reasons to invest, find all the reasons you choose should not invest in that company. And if you cannot come up with any strong reason, then you should invest in this company. I think we talked about, these were the 4 things that we talked about as far as looking at any company in the framework, right? These are the 5 companies that I'm going to take you through today. We do have enough time, so that's awesome. Any questions before we dive into these 5 companies? So as you can tell, these 5 companies, one is farming, robotics, one is completely software edge computing, one is a fintech company, one is a cybersecurity for microprocessor, built-in security instead of a software layer, it's a hardware layer, and more, it's a sexual wellness brand. So that's a CPG company. So let's take a minute here. I know I kind of ran through this really, really fast. I want to make sure that I answer all the questions, and I'm going to take a drink of water. So please let me know if you have any questions. I haven't put anybody to sleep, right? Because I can't see your faces.
This is Laura. I just have a quick question. You said your mentor told you find reasons why not to invest. What do you do with all of that information? Like, because I mean, how do you evaluate how do you evaluate it from there? Because if you find all the reasons to not invest, you'll always say not to invest.
Yeah, it might be true for majority, but but there are companies that, like for example, I'll give you, we talked about Mojo Vision, right? So high valuation, I shouldn't be investing in that because that goes against my thesis. The technology that I don't understand well, but I feel that I can use it, right? If I have this, very smart contact lens, which helps me be more productive, or whatever it is, I think I will adopt that. But so the reasons for me there not to invest was high valuation. So what I'm trying to say is that find all the reasons why you should not invest. But if you do have that conviction at the end of the day, and you do want to be part of this technology, this innovation that you really feel that you align with, that reason supersedes my reason of valuation. So I'm not sure if I'm answering your question.
Yeah,
Laura.
it comes down to conviction on the story.
Yeah.
If you,
Laura, I was just gonna say, a good way you could think about this question that Jags asks here is a gauge. And so there are almost always going to be some level of reasons to invest and not invest, right? And it's almost like, okay, do you have 5 red flags in the do not invest company? Is it too much of a reason to not invest that I shouldn't make it? It's a little bit of a gauge, and having some accountability to your process. If it ends up that the reasons you shouldn't invest are that I'm in a sector that I don't know the answers to 4 of the things that I really think are important, maybe you shouldn't invest. So in other words, pulling out, I like to also think about it as poking holes. We have an advisor on our fund who's great at this. When we are doing due diligence, he goes through and he says, yeah, but what about this? But how about this competitor? Boom, boom, boom. And he just goes down and he pokes those holes. And then we take the next stage in the process and say, okay, could that be fixed? Is it better than, and you start asking those questions, and it just becomes a little bit more of a process of refinement to make sure you're making a smart decision. Does that answer your question?
mm-hmm. Yeah, no, that's helpful. And it makes me think about conversations I've had with a lot of investors over the years.
Yeah.
And this entire thing, in my opinion, is an art more than a science. Science helps us do the due diligence. Art, meaning the other reasons that we cannot put it in words, right? For example, Mojo Vision, completely not in my thesis to invest in such companies. I just got so excited by the technology. I looked at who else was investing in this. I saw this as an opportunity, not only investing in a technology that I was excited about, but also I believed in the team. Not that I knew the team very well. Like I told you, I didn't even get a chance to. Yeah, I talked to them as part of the investor call, but I didn't have this one-on-one conversation, which I usually have with a lot of early stage companies. So I went and I wanted to see, right? I stepped into their office and I'm like, yeah, this is really great. People are, I could see that there was sense of excitement. There was sense of, yes, we are creating something that was awesome. Then I looked at who else is investing in this. And I'm like, wow, these are some of the people I highly respect in this field. So not because I was investing because they were investing, but I also saw this as an opportunity to put this in my portfolio and have that as an opening conversation with the fellow investors who I can say, hey, on LinkedIn, right? I would love to connect. I'm a fellow investor in Mojo Vision. It opens door for me also. So there is a lot of reasons that superseded the reason that why I should not invest in this company.
Okay, that's very helpful. Thank you.
Welcome. We talked about this, and yeah, so we talked. So this is where we are. So let's dig through it, right? I'm going to stop sharing, and then I will share. All right. Can you guys see this? All right. Can you guys see this bear flag?
Mhm.
Okay. I only invested in one of these companies, Macrometa. I'm an investor in that. But I looked at all this and I felt that this is a really good example to go through because it's, few different industry, right? Okay. So the problem, right? Clearly defined problem. So now think about the 80%, right? We talked about 80% to be the same regardless of the sector. So this is the problem that they're going after. What is their solution? Self-driving technology for tractors and farming equipment. Do I know anything about farming equipment or tractors? No. Can I understand the solution, the problem and the solution? Yes. So if I look at the problem, which was labor pool is disappearing, right? We all know that with the immigration stuff that's happening, and also a lot of the California labor is actually immigrants, right? Who have come from different countries and they have experience in this. So labor costs are rising, climate change is shrinking the operational windows, right? The crops are being frozen, whatever not. Solution is, one human per 3 tractors versus 1 human per tractor, 500,000 savings per tractor per year because they're operating 3 tractors with 1 human. The machines can go on 24 hours and that increases the yield, right? How it works. This is what they're all about. The mobile controls is like, the humans have control and they are actually operating the tractor. So this is a completely different design of the tractor, right? Now this is similar to Nautilus, right? They are going into an old industry with a new solution. As the climate is changing, as our oceans are rising, or whatever it is, right? This is the business model. 67,000 per tractor upfront and 14,000 a month. That's where their subscription fees become very attractive. If I have one of their tractors, right, and if I'm buying, if I spend this much money upfront, what are my chances of staying with them? So my LTV is really high. Every customer that comes to me is going to stay with me for 5 years. That's what they are basing on, right? And from that, they can also, do what do you call upgrades, right? They can retrofit the tractors with the autonomous technology. As autonomous technology itself is in its early stage, it's going to change. So how, instead of replacing the entire thing, they have designed it such that they can retrofit the tractors as the technology changes. And there are other services, like the software services, or maybe the service of the actual tractors, right? There are other revenue models also. TAM, SAM, SOM, right? What is the market? What are they going after? So this company is based out of Monterey, California, right here. They are looking at California. This Central Valley is a salad bowl of the world, or the US, right? A lot of farms and a lot of stuff that's coming from California to the rest of the United States. So that's where they're saying that if they go after the 1% penetration of TAM, they're about $770 million. So this is what I was talking about a few sessions back. If your SOM is around 100 million, it becomes very attractive to ventures. That means that you are going to be a unicorn because you have 1% of the company. And if your market size raises, grows from 1% to 10%, that is $1 billion in the next 5 years. This is their competition. So everything that we are looking at right now is the 80% of the due diligence, right? In this farming company. Traction. They are talking about how much, what can I get out of this, right? As far as, the partnerships with the commercial or, with the vertical farms are happening too now, right? So they are also designing things for vertical farms, the indoor farms. So there's a lot of stuff that's happening in the agriculture area. So it's not just farms and acres and acres and acres of farm laid out horizontally. Now we have vertical farms that are also needing services like this, and also indoor farms because of the climate change, right? This is the roadmap. This is the team. This is where I feel the 20% matters, because if the team does not have the experience that it's needed, or it's the not just the founding team, but the supporting team doesn't have the experience that it's needed, it's probably not going to be, they can only take it so much forward. And usually the VCs come and they replace the CEO, or the, if the company's, to be a unicorn. From this, I can see that, yeah, they have a lot of, corporate marketing, big Lockheed Martin, big project, because this is not small hardware that you just develop. This is huge. Boeing, all that is really important for me to know. And then at this point, I'm going to go deep into doing my own due diligence on LinkedIn. Who do I know who knows Aubrey or Igno? And how do I get more information that is not published outside? I also obviously would like to hear from them or talk to them. So a lot of the 20% of my due diligence, if I don't know the sector, comes from knowing the team, what they're about, what is their, going back to the founder, y-axis, x-axis plotting that I talked about. This is where I really go deep into it. What is the capital raised so far? How much have they raised, and who has invested in them, and what is what are they asking? So this is the investment evaluation that was done by a set of investors like myself, and they spoke to current customers, potential customer interviews, the analysis of market landscape and competitors' technology assessment from leading EdTech VCs, right? So you can also call somebody in your network or say, I'm thinking about doing this, and do you have any feedback? I know you invested in this. And a lot of times I also just go on LinkedIn and I send an email to a VC. 90% of the time I get a response back, especially from big VC firms. But 10% of the time I do get it, and then I build relationships and I get to know more about their thesis and why do they feel that not only this company but this industry. What is that? How do they look at this industry in future, 10 years out? Remember that we talked about the 10-year. I talked about the 10-year thing. 10 years out, where do you think this industry will be? And these are the reason they, the set of investors who did the due diligence like it. Large market opportunity. If the market is really small, doesn't matter how good the idea is, execution is going to hit a glass ceiling or a ceiling. Is industry ripe for disruption? Example here is, I don't know how many of you know Webvan, right? Webvan in 2000, 2001 was delivering groceries. I used to use it all the time, but people thought it was really weird. Industry was not ripe for disruption. They wanted to go to, market and field tomatoes and make sure that that's what, and we still like to do that. But however, actually COVID had accelerated that convenience factor that we all are very, very happy with right now. I definitely am. And now the industry is too crowded. And if somebody comes and says, I want to do a food delivery startup, I'm going to say, not interested, because it's already, or tell me something that I don't know why you need to do this. So you really want to make sure the timing is right? So now if the Bear Flag Robotics came 20 years ago, first of all, it would be very limited technology because autonomous technology didn't exist then as it does now. And farmers would look at this as they're taking the things away from them rather than contributing to increase their productivity. So the challenges that we have today are ripe for this particular startup to disrupt this market. Their business model, right? What is their margin? 67% to 92%. If they're increasing, I like it because that means they're becoming more mature and software-wise, and their margins are increasing, and they've figured out a pretty good business model that works pretty well. Management team and high barriers to entry. So that's the high barriers to entry is some industries like this one, relationships matter. Like if I have a relationship with John Deere or Caterpillar and I have this product, I would, that would take me a lot, it would be much easier to have these conversations versus if I don't have relationships in the industry and I don't have, I need some certain amount of capital in order to entry. It's not, the last company we'll see is Mod, the sexual wellness company. It has a low barrier to entry because the products don't cost that much, and it is something that, it is not just for farmers, it's for all humans. So that's what I mean by high barriers of entry. The waterfall analysis, right? So this is what I was talking about. The 5-year revenue projection is $120 million. Revenue multiple is 5x. So exit is 120 times 5x is 600 million. So 5-year return pro rata, if I invest right now and I continue to invest and fulfill my pro rata, I will have 11x return. And if I don't do pro rata, then one-time investment will yield into 15x. I always prefer to do pro rata because even though because you're increasing your base, even though you're lowering your return multiple, but you're increasing your base. So if you do believe in a company and it's not bad money after, good money after bad money, then I would do pro rata. But if it's something that, I also know a company that 5 years ago I thought it was pretty dead, and all of a sudden I get a call saying, hey, we are being acquired. I'm like, what? I thought you guys were not even alive. It's like, no, we kind of went into hibernation. We redid our technology, and we are being acquired, please let us know how you would like to get your proceedings, the returns. Pleasantly surprised, even though it was only 2x, I didn't lose the money where I thought I did. So it, and I did not, continue to invest in that company. So it was just one time, 2x. I was pretty happy with getting the money. And I actually borrowed the slides from a friend of mine. So Macrometa is the company that I invested in. Are you guys finding this helpful, or should we stop and have conversation?
I like hearing your evaluation of the different things.
Sorry, sorry, go ahead.
Oh, this is Joan. I like hearing your take on how you evaluate and making decisions, and
Okay.
company in hibernation that gets acquired. No big.
Yeah, and I wish all the failures went through that process, but no. So, all right, so we will continue then looking at different companies.
Great, thank you.
Okay. So this is the software company, Edge Computing Data Infrastructure Optimization, right? So what they are is the cloud applications, they grow and the transactions get slower, data gets out of sync, bills get big fast. They said bills get big fast is that the computational cost, even though, the AWS, Azure, whatever you're using, they get very expensive, the computational cost. So what this company is doing is their solution is faster processing, 100% data synchronization across edge devices, and pay per consumption. So kind of like, pay as you go model, right? I didn't know much about edge computing as much as I kind of learned through this process. However, I'm still not like an expert on talking about edge computing. So if you have any particular questions on the technology, I'm hoping I can answer. Otherwise, I'll get back to you on that. So how it works, right? So currently they had 175 edge regions around the world. So what they're doing is that they're using this edge regions as the distributed systems. So when somebody is not using it, it's just like electricity, the way that was explained to me, that if you have a solar system and you have, you're on a grid, right? If whatever energy that you don't use, you can pass it to somebody else. So that is the basis of this particular technology. That actually the thing that attracted me the most is that how much computational costs are reduced because of this serverless database and the edge computing technology that they have in a place. So it is, that's what attracted me. The revenue model, they have free tier, the consumption, input, output operations, and storage consumed by a customer monthly. So as much you pay for what you use, kind subscription, that if you, premium user, your usage goes up and down, but you know that if you, you could actually not have an interruption with this particular subscription model and support. So what they are doing is, I don't know if you know Red Hat. So Red Hat is an open source platform which was acquired by IBM. And what Red Hat does is that it says, we'll give you all the software. It's open software, right? Open source software. Anybody and everybody can use that software. However, if you need customized solution, please hire us. And they are multi-billion-dollar company on the software that is free to use. So that's what they are also, some of their support model is based on that. There is an open source software that they have, that they allow their customers to use, but then they charge for the service and support. Another example of that model is Redis Labs, right? Redis Lab has a database model that is free to use, but if you want service or support, you got to hire them. So yeah, please interrupt, okay? Tam, Sam, Som, you guys know this. Again, I want you to see, doesn't matter what industry, but the data that you see they remain, 80% of the data remains the same. Competition, right? So this is where they are. Cloudflare, Beth. You're with Cloudflare, right?
Beth is.
Sorry?
Beth is with Cloudflare.
Yeah, okay. So there you go. That's one of their competition, right? So I actually have to check with them on where they are. Currently, Macrometa, currently meaning this was a year ago, used by this brand names that I'm familiar with in the world of tech. Did I go and ask somebody who works at, I have people who works at Walmart, know people, friends who work at Walmart Labs, Intuit, VMware, Verizon. And I actually asked the founder saying, do you have somebody I can talk to? And he gave some customer the context there, but I also went and I said, who do I know who may know this, who works in this similar, tech area in IT at these companies. And just go have conversations with people in your community and your network. What customers are saying, right? This is really a big validation that this is what we are using, and this is how much we are able to, gain from it. Press. I mean, this is a little bit of different things that you will see from different startups. This is the roadmap, right? So this is where they were. I think I invested somewhere. No, I invested here, right out of their outside of their stealth mode. I think I invested in fall of 2019. So this is their roadmap. They are getting ready for Series A. I just got an email. I haven't really looked into it, but I do plan to follow up because this is one of my investment, and find out where they are and how much they're raising, etc., etc. This is the team. I got on a call with Chetan, and I because I am I am part of the Indian community in the Bay Area, and he's out of Belmont, Bay Area. I was able to also find some mutual friends and say, okay, what do you think about this guy, Chetan and Durga? Durga is very well known for the kind of work that he has done in the cloud area. And I know a couple of people who worked at Nutanix, so was able to get on a call with them and say, do you know Durga? What do you think about him as a colleague? I don't say that, oh, Durga is invested, he's a founder of this company, etc., etc. And I'm trying to do due diligence. Sometimes I say this, sometimes I don't. I just want to get to know who the person is. This is what they have raised. This is what the valuation is: 2017 million cap, 20% discount, 5% interest. Previous lead investors are these people. Other investors are these people. And this is what the, currently raising $2.3 million, and the 1.1 is already committed at that point. And this is the investment valuation, right? Due diligence complete. Did we look at the product demo and test? Did we have customer interviews? Did we talk to the previous investors? And also ask the previous investors, are you going to invest again in this round? If they say, nah, I'm not, and then say, why? Oh, because, whatever. Understand what is their why behind investing or not investing. Why we like this? It's a large market. Again, market supersedes a lot of the other things if the market is not big enough. Because I have currently companies in Canada that I'm working with, and they are saying that we only want to be in Canada. Now, Canada's population is 35 million, same as California. So if I look at that, and if they're a CPG company, and I know that the market is really, crowded in food space, and especially for the product they are bringing to the table, it doesn't attract me as an investor. I believe in the founding team. I believe what they're doing is very, very useful, but they want to just stay in Canada. So that's not something that I would
That's
like.
not a good sign.
Yeah, it's
if
not.
they're limiting their scope, sometimes they have a competitive advantage across Canada to gain early traction,
Mhm.
but to only limit themselves to Canada is not a good sign.
Yeah, and then they are in the field of, they had this, they sent me this. They bake this. They have the health, the taste good, healthy, and extremely nutritious bread in a box. Meaning, I just whip it, put it in the oven, and voila, it's so good. But they said nope, we just want to stay in Canada. So there's nothing I can do about that, right? And it's not. It actually they will have a really high. They will have very difficult time raising from investors who want to be in a large market, because large market helps with the multiples and stuff.
Yeah. And that seems like a bad sign for coachability too. Like it's
Yeah.
one thing for them to think about it initially, but for them to not have the openness to learn, say, oh, we really shouldn't be. Like I had one company that was talking about expanding from Kitchener to Guelph, which is like half an hour away.
Mhm.
I'm like, that's not expansion. And
Yeah.
then on top of it, to say they learned and they came back and now they're thinking more nationally and globally. That's always a potential, especially with younger founders. But if
Mhm.
they're limiting their mentality already to say they're not going to do something, then that's not being very entrepreneurial. So
Yeah,
some
I
red
agree.
flags there.
Yeah, I have this on the other company, the amazing technology, really seasoned founder, not founder, a seasoned professor. That's his technology. He is in his 60s, and he recruited 2 more people who are just like him. And they're saying, we just want this. We just want somebody to come and acquire us, because we are going. We don't want to work. To like grow this company that much. So that is even though they have a large market, the founders, again, as Daniel's point, are not coachable. They have a vision of how they want to exit this. And no matter what I tell them, that look, in order for somebody to acquire you, you have to be attractive. Right now, you're not attractive as a company. So in order for you to get attractive as a company, you need to do X, Y, and Z. And they're like, you're not listening to us, Jags. We are saying we don't want to do any of that. Like, okay, there's nothing I can do, right? So
And they're
I
not
think,
listening to your advice, and they're not going to learn and grow and adapt in
no.
a competitive market. And maybe their best option would be to be acquired, but that's not something that would necessarily align with what you're looking for an exit.
Yeah. So
I consider coachability like an actual deal breaker. And it's because I've seen the failures. I actually really think that one of the top 3 reasons a company will fail is if that founder is unable to take outside inputs.
Mhm.
Like I've seen it happen too many times, a couple times with my personal money attached to it. And I'm just like, I personally am.
Lost you, Kate. Kate?
Sorry, I was just saying I personally am pretty adamant about that piece of it.
Yeah, me too. Having said that, though, I don't expect founders to do exactly what I said also, right? And I think Kate and Daniel both also believe in that. But I really feel that they should say, okay, I understand what you're saying. Let me think about it, get back to you, right? And they come back and said, I thought about it. These are the reasons I feel that this may not work. What do you think? This is a conversation versus saying, nope, I'm going to do whatever I want to do because it's my company. But they're forgetting that it's investors' money, right? So it's a relationship that needs to be more treated like a relationship, having conversations. And the more money you invest in a company, more say you have, right? You can have a board seat, or you can have an advisor role, or you can, so you really want to make sure that the founders, the coachability is more about, are they willing to have a conversation and, not just like say no or yes, I do it my way or highway, whatever. And I have come across founders like that, and I'm sure Kate has, and I'm sure all of you have people who resemble that in your life, because we all are people, right? And so yeah. Anyways, I only say that when it comes to my children. So, John, nope, I'm going to do it. I'm there, and they still don't listen
Yeah.
to me. So anyways. And then not that they should, but I'm saying that it should be a dialogue. Awesome. So waterfall analysis, right? So 5-year revenue projection is 30 million. Revenue multiple is 10x because it's a SaaS company, right? We look at the industry. So the exit valuation is probably around 300 million. So my 5-year return with pro rata is 12x. My 5-year return with no pro rata is 16x. Now know that this is just like, this is like having a crystal ball. Most of the times you hope that this goes the way you have analyzed your waterfall, but we all know that many times it doesn't. So, but this is something that tells you in numbers, like, do I want to go back and do I want to, invest in this company? Do I see a path to this exit valuation? Third company, fintech company, Oxygen. My God, I missed out on this company. So they were raising a $25 million valuation. And I'm like, no, I'm not doing that. 3 months later, their valuation jumped from 25 to 75 million because phenomenal, not 3 months later, 6 months later, phenomenal growth, and they raised Series A. So again, you see the trend, problem, solution. So they are serving freelancers, and we know that more and more people are getting involved in gig economy, right? And because of the gig economy, people are also having limited access to credit, the loans, whatever, right? I don't have a W-2, right? I don't have a consistent income, so the banks are not favorable. So they are solving that problem, commingling personal and business. So their platform really helps you keep that those two separate, no matter how small of a freelancer you are. I mean, they have an amazing platform, very easy to use. International money movement, right? So it's digital nomads, people, millennials and Gen Z are, and becoming more of a digital nomad. They're traveling and working and living where they want to live, and they are also the gig workers, right? And unless you're Uber driver or Lyft driver, where you are, tied down with your car in a location, the Fiverr, right? The Fivers and the Upworks, all those gig workers are, from all over the world. Solution: full service financial platforms for freelancers and business, features designed specifically for freelancer needs. So invoicing, LLC creation and business management, useful cashback, so they connect you with the credit cards and all that, or they have their own credit card. I'm not sure about that. And international transfers, easy to do. Their business model, you know that, I'm not sure if you know, but I learned this a couple of years ago, that airlines make more money from their credit cards than actually flying people. Because they collect on the late fees, and the interest rates is just horrendous. So they also are doing the more friendlier version of the credit card. If they are using the Stripe or sort of service, their rate is more friendlier. The lending, right? People need to buy home, buy car, whatever. So they're kind of also lending money. I don't know about the last one, FX trades and remittance, meaning I think it's foreign exchange is very friendly as well. But I don't understand. I don't know the actual 1% on gross transaction volume. I think that's what they're charging, but I'm not sure if it's the only their charge or the total charge, because the receiving end in the other country can be another bank, and I don't know how much they charge, or is 1% inclusive. Market, huge market, huge market. So here you looked at the ARPU, right? In the previous, which is the average revenue per user, and when they were calculating the serviceable addressable market. These are some of the competition. I use Kabbage. I didn't see Kabbage here. I did not invest in this company, so I wasn't interested in this. But if I wasn't interested in this company, I would say, where does Kabbage fall in this, competitive landscape?
Jack,
Timeline.
can I just ask, like, every red flag in my body went off when I saw this. Like, the addressable market is people who wouldn't go to like Bank of America or Chase or something. Like, is their credit that bad, or they have that limited of resources that they can't go to a commercial bank? And if that's the case, how could this company be profitable?
No, that's not what they're about. They're saying that Chase and Bank of America may not help you as a gig worker from point A to point B. So you saw that they help in forming LLC. So they also help businesses create proper legal structures in addition to the banking needs, with lower fee and easy to obtain loans compared to traditional banks.
Yeah, and if this is helpful, Jennifer, this is actually a really interesting market with a lot of potential. In my opinion, the traditional loan structure and the criteria by which they use for underwriting is, number one, very old. They haven't updated it in decades. And it is also incredibly exclusive, because it's based on a certain number of criteria that really a lot of people have big hurdles for and don't necessarily suggest a risk factor. There are a lot of companies actually creating new underwriting risk factor algorithms so that they can open up loan markets for all of these people who, just like you said, they can't walk into Bank of America because Bank of America won't give them a loan, because as far as I'm concerned, their loan underwriting process is really crappy.
Yeah.
So it is that, and then you think about so like Black and Latinas in this country is a big example. And there's actually, and then think about all the money that you can make when you like open up to the market to millions and millions of people who otherwise couldn't get a $7,000 loan. It's actually really interesting.
And does this company take risk if they default on the loan?
Sure. There is a risk.
It works. Yep.
Yeah, but I know that they also have a secondary market in the back, right? It's not like they are loaning all the money that from their pocket, right? They have a secondary market, their insurance in place, et cetera. But I wanted to bring you to this page. See, in the bottom, it says invoicing, LLC creation, usual cashback, international transfer, all without walking into a bank and from anywhere in the world. A lot of the traditional banks, even though they have an app, they're playing catch up to companies like this. They don't have specific the products for example, Chase doesn't have specific products to create an LLC, help you manage your business. I know that for a fact because I'm a Chase customer. I'm also, that's the reason I went with Kabbage. Kabbage was like, there is no brick and mortar, but the service is amazing. I get more percentage, not a lot, but relatively speaking, because it doesn't have the overhead of brick and mortar if my money is sitting there. I hope that answered your question.
Yeah, and I would just, this is Joan again, I agree, this is exactly where I see fintech going. Like brick and mortar is so expensive and you also have to hire bodies to be at that brick and mortar. So cutting that out is huge, and especially if it's almost all virtual anyway, why are you, investing that much into this? And there's a huge number, I mean, frankly, I fit under this because I work at startups who don't pay me in W-2s, even though I'm making, great six figures. So it's not just people who might default, it's the non-traditional folks that end up being, I mean, what's the TAM? It's huge, right? Could you go back to that slide?
Yeah.
I mean, I agree with you, Jennifer. Maybe it's not a demographic you think about a lot, but more and more people that I know fit under exactly this.
Yeah, and here is the
That's
reason,
why
right?
this class is so good, to like open our minds. to
Totally,
different
totally.
ways.
I'm so glad to hear that. Thank you. I was, so see here, living as digital nomads. I don't need a brick and mortar, right? For the user that, for the Oxygen users.
And this is more and more of my millennial and Gen Z friends.
Yeah.
Almost all of them. Yeah.
And my daughters, they're like, what,
Yeah.
Mom, why are you going to the bank to do wire transfer? Like they still laugh at me. Anyways, but yeah, so this is where they were. Initial launch, they were YC badge. They raised 2.3 million and they grew 45% month over month. They did the 25K customers, got to 900K ARR, and I'm still kicking myself for not investing in this company, but that's okay. I just, yeah. So this is great, right? This is what they've done so far. Month over month traction since January 20 relaunch, right? This is the roadmap. He is a very highly respected person in the fintech, Hussein Ahmed. He's a Berkeley grad. It's a local company, and it just, really, really awesome. And if you look at the, experience, Bank of America, credit and operations, right? This guy comes with that kind of knowledge, right? Trilliant, Y Combinator alone is a great, reputation builder. He is total, he has a PhD in computer science, Hussein, I think. In addition to the core team, engineering and AI from Visa, Capital One, and Apple. So that, these are the people behind in this team are also coming with a lot of experience. Corporate development from MasterCard, in addition to marketing, operations, and customer experience.
So forgive me if I'm wrong, but the last two team slides that you showed us had no women on it. Does
I
that
know.
annoy you?
Sorry?
Does that annoy you?
Oh, absolutely. Absolutely. So you know what I do, if I can, so I would always say to the teams who look like this and say, okay, what are your plans for putting women on board? Yeah, you're going to hire women in human resources, marketing, engineering, whatever. What are your plans for putting women on board? And I listen, right? And I want to know how they respond. So yeah, I know that we are not there yet. But do they feel that this is something that they want to, have they thought about this? If I ask them the question that, are you going to have more women as part of your core team or employees? Say, yeah, we plan to hire. But when I ask them a question, are you planning to put any women on board? What's the path? Where are you with that as you grow? Then I want to know that, are they, really, what are they thinking?
Well, and also, if I could chime in, it's also a fiscal reason to do it, right? Because companies that have women perform roughly 20% better fiscally. So even if it's not from a moral standpoint, we have a lot of data about different perspectives in the room, create different, better products.
Yeah.
Happy to share more stats on that, but it's really, and it's great to see. It looks like potentially, I don't know what his background is. The
He's
CEO.
definitely an immigrant.
But I'm saying we're not seeing completely potentially all white male faces that named John. So, I'll at least give them that credit.
Yeah.
I like John's too, just to be, they're great also.
Yeah. However, when the Johns dominate, that's when you and I have a twitchy eye.
That's right.
Previously raised 7.3 million, raising 5 million, Series A. Valuation is 25 million. So you know that that's the post money. So if you go 5 million divided by 25 million is 20%, right? They're raising 20%. Lead investor is Runa Capital. So they are the ones who established the term sheet, and they're probably investing between 10 to 40% of this round. And other investors are, I know 1984 VC very well. I know one of the other investors that's not listed here, a Pioneer Fund right here. So you know what Pioneer Fund is, right? Pioneer Fund is all the Y Combinator founders created a fund. So I know a few founders from the Pioneer Fund that I go back to and say, why are you guys in the, and there are so many, right? So not every person that I know in Pioneer Fund knows, but they have a network of YC founders. So they think, oh, let me get back to you. Let me see who else knows about this or whatever, right? So Pioneer Fund is really an awesome model. I love that model. Investment evaluation, this is what they did. This is what they liked. Growing market, again, 35 billion, world-class focused team, complete product suite. We talked about that. They will not only do the business transaction, but they help invoice. You can invoice through their platform. You can create an LLC and you manage your business through that. You have a credit card and you can also have a loan, right? It's pretty complete. Their LTV to CAC ratio is really high, 16x, which is really good. And it's about 2.7 months for payback for the money that they spend in acquiring customers. Waterfall analysis, right? The 5-year projection is 27 million. Revenue multiple again is 10x because of the industry they're in. Exit valuation 270 million. 5-year return 6.5x. And no pro rata is 8.6x. All right, I think we're going to stop here. I know we have 2 more companies to go through, but we are coming 3 minutes to 11 o'clock. So I think you guys got in, you understood or got a glimpse of different frameworks in different industries, and know that 80% of the due diligence remains, pretty much the same. So any questions before we wrap up for the day? And I'm happy to send you the slides as well. In addition to the slides for the class, I'll just get an okay from my friend Sky at VU. And if he says all right, he gave me a heads up, hands up or thumbs up for sharing this with you. But I would love to also get his okay, and then I'm happy to share the slides. I'm going to stop sharing so I can see your faces. Anything that I can answer for you guys?
Do you have not your favorite sector, but what sector, and you don't have to go into the details, but what sector was your best investment that you ever made in?
SaaS, enterprise SaaS, so far. I have 2 food companies I'm really excited about, but it hasn't exited yet, but it's been only in tech so far.
Okay. This was a great morning. Thank you so much.
You're welcome. And if you guys have any questions, want to connect one-on-one, excuse me, please let me know. I look forward to seeing you all, or some of you, or whoever can make it tomorrow for our office hours.
Okay.
All right, guys.
Thank you so much. Bye-bye.
Bye,
That's
everybody.
great. Bye.
Bye.
Thanks, Great session. Good to see you.